Hello viewers, you've been asking for an S&P 500 scalping Renko based strategy. Well, here it is in this video. It's really easy and straightforward to set up. I use it in my own trading, getting great results. And in this video, I'm going to take you through how you build it, look at some examples, and you can then go and take away what you found and put it into your own trading if you so choose to do so. So with that, let's get into it. As always do your own homework, back test anything that you see on YouTube or any advice given to you. Check it out with your financial advisor. You know, do your own homework. It's very important that you don't just take this as read and go in and start playing with it. You're risking your own money. You've got to be very careful with it. So caveat there. Do your homework before jumping into this one. It's taken me a while to put it together. It looks very straightforward and simple, but it can catch you out if you don't know what you're doing with it. So with that, let's just get into what it looks like. Very straightforward. On the top part, we've got the S&P 500. Now I've got the ticker MES here. That's the micro S&P 500 futures contracts, and as you can see, I've got a block size of 1.5. I'm going to go through the ingredients of the strategy in a minute for you, but just want to give you an idea of what we've got and what we're looking at. We've got here an opening range breakout. We've got this signaling set up here, which is a Darvas box. We've got the white lines there, which are Bollinger Bands. We've got a yellow line there, which is moving average. Here we've got stochastics set up there, and below, which is really important to the strategy, is the VIX. Now often that is inversely correlated to the behavior of the S&P 500 index. I've explained that in other videos I've done. I'll put a link to one of them at the end of this video if you want to find out more about it, but we're looking for an inverse relationship. So the coloured line there is just the VIX, and we've got a moving average to let us know when things are changing. Now, like I said earlier, this is a 15 to 20 trades a day strategy, and it works differently between time zones. So I split two time zones that call it the London morning session and the US session, so we act slightly differently for both. What you're looking at the moment is the US session with the opening range breakout on. We don't have that at play in the London one, obviously, but we do use the previous days. So that's what it looks like. Let's just quickly go through the ingredients of the strategy now. So here are our ingredients to the strategy summarized. Remember the upper chart, that's a 1 minute Renko chart. We're using a block size of $1.5. Indicators, we've got the orb, the opening range break, stochastic indicator set to 1033, the Darvas box set to 3, Bollinger Bands 7, 1.650, there's the settings there, moving average 10, and the lower chart we got the VIX, 15-minute line chart with a moving average of 5. Now I'll put all these onto TradingView. You can find them by just typing in those names and setups. You're probably familiar with them anyway, but they should all be available on other chart packages around the world. They're quite common, quite standard, nothing unusual there, but that's the ingredients. Now let's just have a look how the strategy actually works to give you an idea of the actual trade signals that we'll be taking. Now I'm going to give you lots of options here to take it your own way. It's a very manipulable strategy. You can add, take away, like I said, put on other indicators, do whatever you like to it. It's an idea for you to take away. But like I said, in this setup works pretty nicely for me. Now we're going to start up the top here. Now you'll notice this sell or buy button placed on there. Let's just drill into that. We don't want that one. Let's drill into that one. There we go. It's a Darvas box buy sell, and we've got it set to 3. And I've turned off the actual lines that it produces and just left the buy and the sell signals. So that's giving us almost our entry point to the trade. We've also got, if you notice down below, the stochastics. Now these two aren't always correlated, the Darvas and the stochastic, so you can either decide whether you just want to take the Darvas on its own or the stochastics on its own, or you wait for both of them. Up to you. I do them both individually at the same time, which gives me even more trades. Let's tidy that up. So basically it's quite simple. Like I said, let's just pick on the Darvas. We get a sell signal here. We go down to the VIX, and remember we're looking for that inverse correlation. Now if the VIX is greater than the moving average, it's bullish, bearish, better get that right. And when it crosses down, as you can see there, it goes bullish, and you can work your way through the whole day to give you your trend filter direction. As you can see there, lots of activity, and that's just one typical trading day. So let's go back. We've got a sell, we've got a sell warning there as well, so you can just go straight into the trade there, and we just follow it down, and we get out of the trade by the crossing of the stochastics. That's one option, or you can use the moving average in there set to 10 to let it trail down. So let's have a look at that example there. You can see it never actually crossed. We had that little pullback here, but we've got a double sell, and we go back down all the way there. So that's a real nice move there. Another way of trading this as well is you can get the first sell, you don't close out, you can add to your position by adding another sell. You're doubling up as that goes down. Now why have I got the Bollinger Bands on there? Now the success on this strategy in terms of risk return reward is to have tight stops. So I've got the Bollinger Bands there set to 1.65 standard deviations. If you know about statistics, you know why I've used that. No offset there, which I sometimes use. Let's just zoom in a bit there on that chart to make it a bit more easy to read. Let's just make it a bit bigger. There we go. So you would put your stop, say on this cell here, behind the white line. You can trail it down if you want and get out that way, or like I said, we've got this signal to go in. You've got big sell flag there and the VIX at the bottom, and our stochastics as well also telling us to sell. And remember how we get out when it crosses back above, so we could get out there if we wanted. We could overwrite that with the moving average rule, and we can get back out when it goes back in up through there. So it is a real simple strategy, but another big filter that I use on here is this orb, the opening range breakout. Now this kicks in at 2:30 p.m. UK time when the US stock market opens, so adjust it accordingly to your own area, wherever you're trading in the world from. But what I also do to filter out is that I only take sell signals if it's below the orb, so below there, sell. Ignore the buys. If you want to include the buys, maybe you could trade them at half risk or something like that. You'll say, well, you know, I've missed all this type of up move, but I can tell you there's enough trades in the day and enough sizable ones to make it worthwhile just sticking with the trend there. So I use the orb there as a filter, just quickly clicking on the orb so you can see how I've got it set up. You can see the times set to the first 5 minutes of the US open there, 9:30 to 9:35. That's set in US time. Like I said, that's 2:30 to 2:35 UK time. So that lays to me the footprint of the day, saying that anything but, you know, if the price is holding below it, it's a bearish day. Goes above it, it's a bullish day. But like I said, caveat is you can trade the buys. Now going back again, it's a manipulable strategy. You can play it as many times as you like. You can ignore these, or you can trade them. You can go the full risk if you really wanted to and ignore the orb. But I like to put the odds more on my side, so I include the orb there. Where I don't include the orb is what I mentioned earlier about the London session, the early morning session. Now that often operates very differently to the US session. So when the US money comes in, mid day UK time, it changes the trend that we've seen before, which has been rolling out over the morning. So if I just pull this back a little bit, this chart. So this, like I said, is just one typical day. The block size is very small, so we get a lot of action. And now you can see up here the previous day's orb. Notice there's the overlap there between the 2 days. But obviously in the UK, the day's starting a lot earlier. Now I start on this one from 8 o'clock. So we haven't got the orb at play for the new day, but we have for the old day. So again, the same sort of rule. If it's below it, I'm looking for bearish trades. So we got this really nice one here at 1 o'clock where we pull on down, and if it's above it, I'm looking for bullish trades. One way of playing it. Now, just to reiterate as well, the stochastics you can use purely on their own as well, as they cross and go up through the 20 or cross and go down through the 80. You can use that setup as well, and remember, always use the VIX at the bottom to marry into your strategy. So pulling that further back there. Now the problem with the 10th of January, which we're looking at there, that was a bank holiday over in America, so we didn't have the VIX starting quite as early, so I would have ignored and wouldn't have traded that morning because of that, and the VIX actually opened up later in the day. So if we rolled it back another day, we go scrolling our way through, you can see here's another one. Again, there's the overlap that you can see between the day and going back to about 8 o'clock in the morning, which got us about there. So we've got all that period before the US market really even opens. And again, if we pull back the VIX to the previous day, so we've got Wednesday there, like I said, Wednesday 8 o'clock. Let's find Wednesday 8 o'clock on the VIX. Let's pull that back, and we just got a little far there, and you can start to see. Now remember what I said, if the VIX is above the moving average, bearish, below, bullish. It's as simple as that. So there's the 8th, here's our 8 o'clock, and as you can see here, it's a fine line, but it's below there, so we'd be looking for up trades there. So again, up to you how you play this. Now you could say, well, it's previous, orb was there, the price is below it, so it's bearish, so I'd only be looking for bearish trades if the VIX confirms that. And at the moment we got bullish. We did have this little period of time around about there, it's about 9:40 where it did turn bearish, so that's about there on the chart. So you might have got into this bearish trade here on that basis, but as you can see, really opens up on the Wednesday at about 10:55, 11 o'clock. That's bearish. We're under there, it's bearish, and like I said, you definitely would have got that trade in there. You'd have taken those trades there even before the US opens up. So it's not much more to it than that. Very simple, very straightforward, and you can play it until the close of the day. You've got various options. Let's just go over and re-summarize. Let's tidy it up. Let's get rid of the drawings there. Here's the Friday we just been through, and as you can see, lots and lots of trades to play. We've got our bearish marker here, right, because it's gone above. What time does that go? That's 7:55 onwards. So all these trades here are all potential buys, sells, because under the orb, it's corresponding in with stochastics, crossing. The sales are up to you how you want to do it. do you want to do the Darvas, do you want to do the stochastics, do you want to tie them both in together, use the moving average, Bollinger Bands for your stop loss to trail it down, or initial stop to give you that bigger trade size to make these small moves worth it. Remember, this is a scalping type strategy, so you know, if you're being really super conservative, you'd put the stop loss above the other side of the order, but we wouldn't make any money that way. It wouldn't be worth our time. So we've got to take some risk by bringing the stop in close, and that's what the Bollinger Bands are there for. And literally, you could just log up this screen and sit there and work your way through the S&P 500 all day. And you can use this on all the different tickers, the SPX, the ES, the MES, whether you're spread betting, CFD trading, you know, works nicely on any derivative of the S&P 500. So that's the setup there. Like I said, simple, straightforward. Looks a bit messy to start with, but once you work your way through it, set your own charts up. It's a fantastic strategy. Let's just summarize those rules very quickly. You've got firstly the VIX filter, greater than less than the moving average. If it's greater than, it's bearish. If it's less than, it's bullish. Then we've got the orb filter. Remember that one, price greater than the orb, it's bullish, and vice versa. Then we've got our signals from the Darvas and stochastics. Got to be in the directions of 1 and 2. Number 4 there, don't forget to use the Bollinger Bands for stops. Go the other side of the band. Got to be tight to get the best risk reward. Exits on the stochastic cross, whether that's when it crosses or goes up through the 20 or down through the 80. You can trail the Bollinger Bands and get out when it closes through them, or you can use the 10 moving average cross, like I said, and we saw in that example. It allows you to stay in the trade and build up positions if you get other signals within that. You know, while maybe it's a big long trend move down or up, you can then build up the position within inside that move. Note for the London session, use the previous day orb filter. Up to you as to the combo of all those that you put together. Remember, test them out yourself before going live. And you're looking for a 65% win ratio or greater and risk reward target. I'll look for 1-to-1 or greater. It doesn't matter if it's less than 1-to-1, you know, if it's 0.7, 0.8. Just got to keep on top of those statistics, and you've got to make sure that win ratio is higher. There you go. Hope you like that S&P 500 scalping strategy idea. Like I said, it gives you 15 to 20 trades a day. Win rate, you're probably looking 65-70% plus. Then you've got to, you know, work out your risk return, which on this sort of trade you're looking for 1-to-1, maybe not, if not a bit more. But always keep track of your statistics. Really important to know what you're doing with this type of trade, and keep on top of those numbers, because if you're not getting the risk return to the win rate, then you're going to lose overall. So very important to keep track of the results, but they're the sort of areas of targets you're aiming for. Let me know in the comments below what you think of the strategy. Do you do something similar yourself? Do you utilize the VIX in there to advantage, to, you know, take advantage, like I said, of that options mentality, the way those guys are plugging in those numbers to give you an idea of the direction they think the market's going to go in? Let me know in the comments. Love to hear from you there. Now, if you like the video, give us a thumbs up. Don't forget to hit the subscribe and bell buttons to receive future content notifications of stuff like I'm doing just like this. And want to learn more about Renko? Well, I've got a course on the YouTube channel, playlist all together, totally free. Just work your way from top to bottom and you'll come out the other side a much better Renko trader. Also said I was going to put a link to a further video on the VIX so you can understand that some more. And also just to mention the Renko book coming out in the first quarter of 2025, a link to that as well if you want to find out more, all coming up right now.